Good morning, everyone. Welcome to yet another episode of Macro and Market Moves by MK Global. Today, again, we have Mr. Yatin Singh back in our show, and he's the head of investment banking here. So let's get into our interview with him now. Good morning, sir. How are you?
I'm good, Bhargav. Hi.
Yeah, and if we look back at 2024, it's phenomenal year for the IPOs, especially with almost 91 IPOs hitting the market, especially in main board itself. So I think this is a phenomenal run. And if I look back in the past for the IPOs, this has been the highest since 2007. And if we look at the number also, 2007 it was 100 IPOs, and then now it's again we are reaching that kind of number. So, how do you look at the market and especially the IPO market as an investment banker? And how is this particular market in 2024 different or similar to 2007?
So, I think other than the fact that the number of IPOs is very large, there are barely any similarities between 2007 and now. 2007 was the peak of global economic activity in recent times. Unfortunately, what followed was the global financial crisis in 2008. So, of course, what was happening then had a lot of top-down positive rub-in from the global macro environment to India and the capital markets of India, which were doing well, and global capital markets were doing as well. In 2024, the situation is remarkably different. Global economy is by and large not in a great shape. Yes, there may be some pockets like US which are doing better than other developed markets. Even developing markets, barring say India, are not really performing as well as they were back in the day. Capital markets 2024, if you see, even for India, it's not been in terms of absolute return a stellar year. Yes, there have money has been made, but it's not been a outright stellar year like 22 or 21. So lot of differences. I think another major difference between 2007 and 24 is the supply of money. Back in the day, the fate of IPOs largely depended on FII participation, right? That has now flipped completely in favor of domestic money because of the robust SIP inflows. So I would say that is another major difference. So, to sum it up, things are very different now. Things are from a Indian context is healthier because we are not dependent on the vagaries of global capital flows. We are not really dependent on global capital markets doing very well at an aggregate level. This is the strength of Indian macroeconomy and the robustness of domestic flows which has made 2024 a success as compared to 2007.
Okay. So, given this background, how do you look at the markets for 2025? How do you think it's going to be? So, will there be a what we generally call as high base effect because of large number of companies hitting the markets in 2024, or is it going to be a continuation of the new trend, or because of the inflows which you are speaking about, domestic and all? So, how do you see 2025 is going to be, especially for the IPOs and QIPs?
So, I think the trend will continue simply because both the demand and supply sides, the underlying realities have not really changed much, at least in the whatever days of January we have seen. So, if you see the number of DRHPs that are filed and what we hear from the street, the numbers that are in the works, it's a reasonably large number. Simultaneously, if you look at the SIP inflows, they are also holding up reasonably well. So I expect the IPO markets to be fairly active. Now, will calendar year 2025 growth mirror the growth of 24 over 23? Maybe not. And the reason for it that IPO is a physical process, right? I mean, when we were growing up, we were told that more than two IPOs in a week is something that the financial ecosystem of India cannot process. Of course, the ecosystem has matured. There are newer payment channels like UPI. A lot of broking has moved from physical to digital platforms. But despite that, I mean, yes, in December we had a couple of weeks where some 8, 9 IPOs happened, but it's chaotic. Right? I think typically 2 to 3 IPOs per week is what India can or any market can absorb at the maximum. If you multiply that by 52, the upper cap is somewhere between around 150, 160. Now, of course, there will be Diwali week, there will be other kind of periods in between where the prevailing secondary market situation will not be ideal for an IPO launch, right? So I would say that the natural cap is somewhere around 120, 125. Whether we will hit that number this year or not, only time will tell.
Great, great.
On the QIP side, similar. I think there it's different because the turnaround is much faster, and there companies can look at immediate growth initiatives, assuming that capital is available, right? So a lot of sectors have seen capital intensive sectors have seen a lot of activity in 2024. That trend should continue in 25 as well.
Got it. So since you touched upon QIPs as well, even if you look at the QIP numbers, 24 was phenomenal year for that, because raising almost 1100 billion rupees just in QIPs, I think Indian markets have never seen that. So what has exactly changed? Is it a trend for the companies to look for capital markets whenever they need money, or rather than going for a debt? So, or do they see this as an easier way? So, what exactly is that?
So, companies have now learned, most of the mature companies who've been around for more than a decade, they have learned that the window of capital availability on equity markets is not open all the time. Yes, we've been having a decent run for the last 2, 3 years, but that the period preceding it was very, very challenging. And hence, companies understand that they should, bolster their net worth, raise equity when markets allow for it. Currently, the environment allows for it. But that's more of a supply side. I think fundamentally most companies which are also doing QIPs like IPOs are raising money for growth, and there are a whole bunch of sectors in India who are seeing very robust business prospects. The GDP number of Q2 notwithstanding, I think that will bounce back this quarter, and growth needs capital, and at this point of time companies are able to maintain a healthy balance between debt and equity, because equity is also readily available. So we should expect a lot of QIP activity in 2025 like 2024.
Got it. So when we speak about sectors in specific, so what we have observed in 2024 is that sectors like auto, consumer, IT, and BFSI. So these four sectors have performed exceptionally when it comes to the share in terms of the amount raised from the capital markets, be it an IPO or a QIP. So what do you think it's going to be for 25? Are these the 4 to 5 sectors which are going to continue, or are there any emerging stars?
So hard to say, Bhargav. I think the sectors that you mentioned happen to be at the top of the pack because we saw some very large transactions last year, like a Hyundai IPO, Hyundai India, right? Those kind of IPOs will not happen every year. Similarly, Home Finance went public, right? So that also was a big skew towards the BFSI sector. Swiggy went public, right? So when you're saying IT, I'm assuming you include new age tech-led businesses as well. So Swiggy went public. So I think, value-wise, Will we have similar sectors topping the charts this year? I don't know. One thing I can say with some degree of confidence is that your IT or the new age digital
Tech
businesses
focus.
or tech-led businesses, they will continue to tap capital markets. We hear that OYO is about to file, so that's going to be a massive one. There are some other big ones in the pipeline, so that will continue. Otherwise, I think if you look at not value but the number of deals, there are a couple of sectors which stand out big time. Real estate is one, both IPOs and QIPs. And manufacturing as a large cohort, I understand that it can have various segments within it, but anything which has got to do with the manufacturing theme, those are sectors which are A, seeing a lot of growth tailwinds, B, are also reasonably capital intensive, and hence to realize the growth, they need capital as raw material, and hence they are raising money. So I think that should continue in 2025.
Got it. So when you say manufacturing, so do you mean that it is linked to the capex, ongoing capex cycle?
So on the capex cycle, some of it is something which is fostered by the government PLI schemes. Some of it may not actually have PLI support, but the underlying fundamentals of the business may be strong enough to support it, support a capital raise. So different reasons in different situations, but India is experiencing reasonable capacity addition in different business segments of manufacturing, and that macro behavior would translate into capital market activity invariably.
Got it. So when we say about one more interesting trend which we observed last year is the rise of real estate,
Absolutely.
because the amount they raised, especially through QIPs, contributed to almost 17% of the overall fundraise which happened in the market through QIP route. So why is this sudden surge? What's your take on that?
So look, real estate is capital intensive, right?
Correct.
But I think the surge is, and real estate has various segments. I think this is one of these periods where most segments of real estate are doing very well. So let's begin with the most obvious and the straightforward one, the consumer facing one, which is residential. Uh, Residential real estate has been incrementally, the health of the sector is improving incrementally from the demon times. And post COVID, it has just taken off like nothing. Inventory levels in most cities are at a very, very healthy levels, the unsold inventory, right? So if you look at unsold inventory, which then automatically translates into new product launches. The regulatory system has evolved now. RERA has been around for some time. So, the benefits of a healthy regulatory framework are accruing. Projects now, by and large, get delivered on time. So there has been a kind of a implicit Darwinian kind of a filtering out of inefficient developers. The lot that is left now has a track record of delivering by and large on time, so they are able to attract sales velocity whenever they launch a project. So it's a culmination of a lot of both demand side and supply side. I think COVID was a learning for every human being that you need to have a home, because you may have to be cooped up in that home for long periods. So that has also dramatically altered buyer behavior. So people are buying houses and investing significant amounts of money to live into it. It is residential is not as much of a investment asset class as it used to be earlier, in my opinion. Of course, there are still very healthy pockets of interesting investment opportunities as well in residential, but a lot of current volume of take is for end use. So that's residential. If you look at commercial, and you can look at it in both, as a developer as well as flex space, co-working, right? So Emkay was a part of the IPO of office last year, and half a dozen co-working companies have either filed their DRHP or are in the process of filing it. Ultimately, these guys also lease space from a developer, a commercial developer, right? So it's just a aggregation layer on top of it. Basically, commercial real estate is a closest proxy on the whole GCC, Global Capability Center, boom that is happening in the country. And as these MNCs come up and set up base in India, they want quality office space, and that is triggering a lot of demand. And then you have some very new emerging areas like data centers, right? Which also is kind of a real estate play. Now that is also very capital intensive, and again, seeing a lot of growth. So residential, commercial, data centers, warehousing, all of that coming together is creating a lot of growth in real estate as a broad cohort, and growth has to be supported with capital. Of course, there is debt, but you need equity as well, and hence you see real estate being a large constituent of the fundraisers that happened last year, and I expect it's going to continue this year as well.
Got it. Understood. And so, just to sum up the entire thing into just 2 or 3 points regarding real estate. So, man, please correct me if I'm wrong. One is renewed demand from the consumer side, and other is the stricter regulation, which improved consumer confidence. So, the next is the shift towards global capability centers in the commercial space, and new avenues like the growth in warehouses and other commercial side, data centers.
Absolutely.
Okay, got it. So, just moving a bit away from the capital markets, our interest rates in India have been stagnant for a while now. So, also there is a new chief of RBI, and so do you think that there is going to be any revision in the interest rates this year, like interest rate cut, due to which there can be a significant significant demand which comes into capital markets or something like that?
So I'll separate the question in two parts. The first one on my view on interest rates. I'm not an economist, but whatever little I understand, we've been holding our interest rate levels for longer than most of the developed markets. UK, Europe, Canada, US, of course, the Fed, all of them have reduced interest rates. We haven't. The reason we haven't done that is because our inflation, the way it gets calculated at the consumer level, the stickiness is very high because a large constituent of that is food, and within food, fruits and vegetables, the volatility in pricing has been extreme of late, right? So the aggregate inflation number is still above the mandated 4%, and hence, Reserve Bank and the Monetary Policy Committee has, in their wisdom, decided to keep it at the current levels. It has its own implications, one of which is that the cost of capacity creation for the private sector is higher than what it should be, particularly given the fact that food inflation has reasonably high inelasticity vis-a-vis interest rates. People are going to eat whether the base rate is 6.5% or 6%. So to that extent, from a domestic standpoint, interest rates should and could come down. Also, in an international context, there's a lot of volatility right now, but we don't want a situation where the real effective interest rates for rupee is at a huge variance as compared to the other emerging market basket, or even developed market currencies like the dollar or the pound or the euro. So to that extent, our central bank will, in my opinion, maybe with a lag, follow what is happening broadly in the rest of the world, which seems to be reduction in interest rates. So that's my call. Now, your second question is the correlation between interest rates and capital market
Capital
activity.
markets.
Look, we've been, as I mentioned, we've been holding on to the current levels for a while. The capital markets activity last year was, as you yourself mentioned, the highest after a very long time, after 2007. So I think, there the correlation, there are certain sectors which are highly sensitive to interest rates, and there, you may see increased demand if the interest rate situation becomes more favorable. But by and large, even without that, I think we'll do okay.
Understood. And good to hear that as well. Also, since our budget is going to be tabulated next month, Feb, so what is your personal opinion, and what are one or two key points which you are expecting from the budget?
So this is more as a not as an economist, but as a citizen,
Yeah.
someone who has some understanding of markets and macroeconomy. I think our taxation needs overhaul. I mean, everyone agrees that. I'm sure the government also agrees that we are hearing that there may be some developments there. I think direct taxation, personal taxes in India are way too high, and that is now reflecting in the subdued consumption metrics that we are getting, particularly in the urban areas. Rural is cyclical, but I think now it's on the upward swing. After a very long time, rural is doing okay. Urban, which was kind of doing reasonably well after the COVID, I think all that pent up demand is now exhausted, and to bolster consumption, the government needs to put more money in the pockets of citizens, and that, to my mind, will require both simplification and, dare I say, reduction of tax rates and the overall taxation framework in India. So I think that's one thing that I hope this budget has, some progress on.
Yeah, let's wish that that's going to happen. And that's all I have for now today, sir. And thank you very much for your valuable
Thank you,
time.
madam. Thank you.
Yeah, thank you everyone. And we hope you all had a informative session. And thank you very much.
Thank you.